All right, welcome back to the final round here on Yahoo Finance. Miles Udland with you in New York. For more on today's sell-off, again, we are at session lows right now. The Dow off nearly 1,000 points. We're joined now by Lee Munson. He's the president and CIO at Portfolio Wealth Advisors. Lee, always great to see you, man. Let's just kind of take it from the top, what you make of today's market action, and then maybe we can get into what the setup looked like, ahead of this little bump.
On first glance, it looks like nothing was happening today. It's as if there is no news. I can tell you that these job numbers that are coming out and looking at this stuff, it's not good. Yesterday, we had such a rush up. I was depressed yesterday morning thinking, why don't I just throw it all into the Qs? I actually told my trader that yesterday at around 8 in the morning. And so, as a contrary indicator, I think that says a lot. I think really what's happening now, we're starting to see the effects of this short gamma trade in options that a lot of traders have been talking about. To explain that simply, it just means that because people are only buying calls right now, call options, betting things are going to go up, that dealers who are selling these contracts, they're basically short, when you're long. They're having to go in this feedback loop where they have to keep buying more and more and more. Volatility goes up. And the way you do this wonky formula is as volatility goes up and the stock goes up, you just have to do it. We saw this with Nokia about 20 years ago, and it killed a lot of option dealers. So I think that's finally starting to catch up. Yeah. And probably in another couple of weeks, we're going to hear about this more in trader blogs and stuff about how there became a point where all of that binary nature just stopped. Remember, it's kind of like March of 2000. There wasn't any particular thing. It was just one day everybody wakes up and realizes there's a lot of people and a very small door.
And I'm trying to get out at first. And I guess given that kind of outline there, then Lee, in my mind, the meta question would be, if we're so focused on the books of options dealers who, nominally are not controlling that much money, it's a large notional amount, but nominally it's not that much. Right. Is that basically saying that the market was so fragile that this small event was going to be enough to lead to a 7% decline in a single session like we're seeing today?
Yeah. So what it does is when you have, and again, if you're an option dealer out there, and I'm not explaining it just like, you can send your hate mail to the circular file. When you're in what's called a short gamma situation, which is a very fancy word, all I'm trying to convey, and this situation is trying to convey an environment where as things go up, it adds amplification. It fuels the surge up, but it also fuels the surge down. That's why a lot of bearish people, I'm not that bearish, come on. But, I'm underweight in stock, put it that way. I'm underweight in tech, put it that way. Why the bears are talking this up is because when you're short gamma, when things start going south, it amplifies it. It's like when I was back on Wall Street into the dot-com days, we were always on margin. So, when my Yahoo stock was going up crazy, I was making twice as much money. It was happening very quickly. But then on the way down, you start losing twice as much. And the selling begets more selling. So you just need to understand in general, if the speculators, if you get upward or downward movement, if it's going to be exacerbated, or if you're in a situation like March where it's more muted, where a lot of dealers are long gamma, so they're buying every dip and selling every rip. We're in the opposite effect. That's why I even bother mentioning this today. I think it's one factor, but it's an important factor we're going to find.
Haley, so with the short gamma side of the things, I also just want to bring up the retail side of this equation, because we've talked about the retail investors and the role that maybe they have or have not played in this massive run-up that we have seen. But when we see a type of day or the weakness that we're seeing today, and some of these trades that have worked in the past starting to crack and starting to show a little bit of weakness, do you think the retail demand is going to start to fade because of that?
Well, you saw these newbies, the Robinhood kind of set, several months ago. All the anecdotal evidence says, well, we'll just buy on every dip. We started buying in March on the big dip. We'll just keep doing this. We're going to see if they really want to put their money where their mouth is, because they haven't seen a real correction, right? All they've had is the happy. And now we're going to see something else. Maybe this is just a one-off thing like we saw in July. I don't know. I think it's more. I think the rotation, I think there's evidence we'll get into in a second. There's evidence that the down and outs are losing a lot less money right now versus the NASDAQ. I think it's important not to just focus on retail and remember that you also have major institutional players that have sold their hot FANG stocks and have replaced those positions with out of the money call options as well. So I think the more pertinent issue is, are those institutions that sold their stocks, replace the hot stuff with call options, are they going to press their bet because they're a much larger player dollar for dollar? And the answer to that question is, I don't know. But the whole reason a pro manager would sell stock and buy out of the money call options is because they think it's crazy and they just, it's a lotto ticket. They're not going to chase this thing down. And so again, retail, they claim they're going to buy the dip. Institutional, the very nature of using calls versus the physical is all about not chasing it down, if that's a good response, if you can read between my lines there.
Yeah, and Lee, I guess thinking, more broadly about the market right now, today is exactly 2 days away from the election. And we have heard for basically 4 years that the 2020 election is going to be this big inflection point for markets. And I think, the term structure of the VIX had certainly been suggesting for some time that it was going to be probably the biggest vol event that we've seen in some time. Everyone has been bracing for this. So is anything that we're seeing today, maybe not like we're not responding to polls or whatever, but what we're seeing today is people kind of cleaning up their situation as we get towards what we know is going to be, or what we expect will be a major volatility event.
Oh, I think your point is, the question is so spot on. By the way, can we just pause a moment and just remind the viewers that isn't it damn awesome that we can say VIX term structure on this show and nobody freaks out? I love that we can just get into some actual meat here instead of just talking about, Tesla all day long. The term structure is so important because it's this narrow bullet in November, as if the whole market is set up to say nothing bad will happen until the first week in November. You know how that goes. When everybody thinks they know what's going to happen, it doesn't. And so I think that's what we're seeing here today. I think people are trying to front run that machine. They're trying to front run something they know is going to happen. I've got Republicans and Democrat clients calling me saying, hey, if you think that this November thing's going to be wild, why aren't we pulling back now? And the answer is, dude, we have been. Like, of course we are. So I think that definitely people see it. We're starting to get the picture that it doesn't matter who wins. It's that the uncertainty that it's going to cause is panicking people. And also, there's other interesting things, like if either party starts shouting infrastructure in a theater, people are going to freak out because it's going to cause inflation to start skipping. It doesn't matter if Trump wins, it's going to be energy infrastructure, or if Biden wins, it's going to be windmill infrastructure. You're still talking about cement and lumber going through the roof. That's going to spark inflation, and the Fed won't do a damn thing. And so then you get stagflation.
Certainly something that we can discuss depending on what happens in November. But you brought it up. So last question: are you worried about Tesla down $100 from its high? Come on, man.
All those people that bought yesterday. I'm not worried at all because here's the thing. Here's what we're worried about, right? My largest position is like the S&P 500, right? And even though I have a lot of other stuff, and when 40% of that S&P is the NASDAQ 100, while I may not be worried about my small value, my master limited partnerships, my gold miners, my emerging markets. I may not be worried about those. But when you have a big core position like the S&P and you take those momentum things out and you start to push them down, it mutes your big pool that every investor in their 401ks is putting money into every month. And that could have a psychological effect. And so I think that when you see that rotation into value, value's down very little today and the NASDAQ is not. A few percentage versus almost 10. When you see that rotation, you could see big pain in the S&P, or at least mild sideways crappiness, where you get these other areas of the market where the money's flowing into. And again, it's like a small door entering the value play and a lot of people wanting to go in. And so I would just expect more volatility. I've been talking about it. I thought it was going to happen last month, and maybe here we are. I don't know how to time things perfectly or own Tahiti.
Yeah. All right. Lee Munson with Portfolio Wealth Advisors. Lee, always great to get your thoughts, and we'll be in touch.
Thanks so much. Have a great day, guys.